Welcome to Sophie Daddy's channel. In this explainer, we are going to decode a powerful income strategy that Wall Street's biggest players use day in and day out. And we're going to break it all down for you right now. All right, let's dive right in. Here's our game plan for today. We're going to start with the why, the big idea that makes this whole thing work. Then we'll get into the what, the specific tools you need to know about. After that, we'll cover the how. And we'll wrap it all up by helping you figure out where you fit into this picture. Sound good? Let's go. Okay, first up, the market's hidden premium. We have to start here because this is the fundamental reason this strategy even exists. You know, the entire concept really boils down to this one simple question. What if the market, year after year, just consistently paid too much for insurance? Well, what's fascinating is that the data is pretty clear. It absolutely does. And that overpayment, it has a name. It's called the Volatility Risk Premium, or VRP for short. The easiest way to think about it is this. You're basically becoming the insurance company for the stock market. See, other investors are worried, they're fearful of a sudden crash, and they're willing to pay a price, a premium, for protection. Option writers are the ones who step in, provide that insurance, and collect that premium. So why does this premium exist? Well, it's all about a predictable and persistent gap between fear and reality. Implied volatility, that's the fear. It's what the market thinks might happen. Realized volatility is what actually happens. And time again, history shows us that the fear is way overblown compared to the reality. And that gap between the two, that's the profit zone for an option writer. And hey, don't just take my word for it. This isn't just some abstract theory. The data is incredible. A huge study from the SIBO tracked a systematic put-writing strategy for over 30 years. The results were, well, they were pretty stunning. Not only did it generate higher returns than just buying and holding the S&P 500, but it did it with way less risk. Look at this chart. During the worst market crashes, the strategy lost significantly less. And that is a huge psychological advantage. Okay, so we've established this premium is real. It's there for the taking. The big question is, how do you actually access it? And this brings us to the what. The tool you choose to use here has absolutely massive implications, especially for your after-tax returns. When you look at what the big money does, the hedge funds, the institutions, the pros, they almost all gravitate towards one specific tool. They prefer SPX options, and they love them for what they call the trinity of advantages. So what are these advantages? First, they're European style. All that means is no surprise early assignments. You know exactly when things will happen. Second, they're cash settled. No messing around with physical shares of stock. It's just a clean cash debit or credit to your account. But honestly, the first two are just nice perks. The third one? This is the real killer feature for U.S. investors. And that is the Section 1256 tax treatment. I know, taxes are boring, but stick with me because this is huge. Normally, if you're trading short-term options, you get hit with the highest possible tax rates. But with these specific options, you get this special 60-40 blended rate. A huge chunk of your gains get taxed at the much lower long-term rate, even if you only held the position for a day. This is a total game changer for your bottom line. Now, this table really breaks it all down. The main issue with SPX is, well, it's enormous. A single contract can be worth $500,000 or more. So for most people, the real choice is between XSP and SPY. Think of XSP as the mini-me version of SPX. It has all those same pro-level benefits, just at 1/10 the size. Then there's SPY. It's incredibly liquid, super easy to trade, but you give up that massive tax advantage and you have to deal with the headache of potential early assignment. Okay, so you know the why and you know the what. Now for the how. When it comes to actually implementing this, you've got two main paths you can go down. You can do it yourself, or you can buy a packaged ETF that does all the work for you. I love this quote because it hits the nail on the head. Having total control feels like a superpower, right? But that flexibility can also be your kryptonite. When the market gets choppy and fear takes over, it is so hard to stick to a systematic plan. The very same emotions that create this VRP opportunity can cause you to derail your own strategy. So the real trade-off here isn't just about fees. If you go the DIY route with XSP, you get that perfect tax treatment and no management fees, but you do need more capital, and more importantly, you have to be your own risk manager. You have to conquer your own fear and greed. An ETF, on the other hand, automates the discipline. It takes the emotion out of the equation. But, and this is a big but, you have to be a detective and look very carefully under the hood. And this is where things get really, really interesting. This is where a lot of investors get tripped up. We need to talk about the hidden tax traps inside some of these popular ETFs. Because what the fund's marketing says and what it's actually doing can be two very different things. Let's look at a perfect case study, the fund WTPI. On the surface, it looks great. It advertises that it's running a systematic put-right strategy, which we know from that CBO study can be really powerful. But here's the catch they don't advertise. It sells options on SPY. That single, internal choice means all the income it generates is passed along to you in the most tax-inefficient way possible, a short-term capital gains. It's a similar story with the massively popular fund JPI. It's a bit of a black box. It doesn't use the standard options that you or I could trade. Instead, it uses these complex derivatives called equity-linked notes. Now, not only does this structure completely sacrifice that amazing 60/40 tax treatment, but it also introduces a totally different kind of risk, counterparty risk. You're basically trusting that the big bank that issued the note won't go bust. That's a risk that just doesn't exist with exchange-cleared products. So here is the bottom line, and if you take one thing away about these ETFs, please let it be this. It is not the advertised strategy that matters most. It is the underlying instrument the fund uses internally. That's what separates the tax-efficient funds built on SPX, like XYLD and SPY, from the tax-inefficient ones. For anyone investing in a taxable account, this difference can be absolutely enormous over time. Okay, let's bring it all home. We've covered a lot. The right path forward really isn't the same for everyone. It depends entirely on your capital, your expertise, and your own discipline. So let's create a simple framework to figure out which approach is right for you. I think we can break it down into 4 main profiles. See if you recognize yourself here. Maybe you're the pro-am. You've got the capital, you're hands-on, and you're very tax-sensitive. For you, the DIY route with SPX is the gold standard. Or maybe you're the sophisticated trader. Disciplined, but maybe with a smaller account. Then DIY with XSP is structurally the best way to go. What if you're the set it and forget it type? You value simplicity, but you're smart about taxes. A well-built ETF like SPYI is probably your best bet. Find your profile on this list and you'll have your answer. Look, the Volatility Risk Premium is a powerful, persistent force in the markets. It's a reward for providing calm in a world of panic. But capturing it effectively means you have to understand the tools, the trade-offs, and most importantly, yourself. You now have the institutional-grade framework to make an intelligent decision. So the only question left is, which investor are you?